All right. I believe we're live, and I actually think we have sound now as we are supposed to. We're going to cross our fingers and hope that that's the case. We're only a half an hour late. This is the time the program should be ending, and instead, here we are starting Moving Markets. Welcome to another day of Moving Markets. Jeffrey Dunyon with Sampson Strategies. Good to have you here. It is Tuesday, June the 8th. The markets have been closed now for what shall we say, a little over 30 minutes. And it was down today, at least for the Dow Jones and the S&P. The Dow Jones finished down about 300 points today. The NASDAQ was up a little bit, and the S&P 500 was down a little bit. Really, profit taking was the story today. I was just reading an article on CNBC while I was trying to get up and going and get my sound moving the way it was supposed to here. That was our issue this morning. That was our issue when we tried to start a little while ago, is that we didn't have any sound. I was reading an article on CNBC that basically says, here's what happened to the stock market on Tuesday. You had Amazon and Apple hit all-time highs, and the NASDAQ went over 10,000 points for the first time ever. Did not finish there, although it certainly wasn't a bad finish. The NASDAQ did finish up a little bit, but 9,953.75. But on the backs of Amazon and Apple, it was briefly above 10,000. Tech stocks rallied, although they had not been performing as well as some Dow stocks over the previous few days. They had a nice big rally today. Netflix, Facebook, Alphabet. I think Netflix and Facebook were both up at least 3%. Alphabet up about 0.25%. The parent company of Google, of course. But, not a bad day in the market when you consider the run up that we've had for the last 6 days. The Dow Jones Industrial Average has gained as many points in the last 6 trading days as it probably gained in the previous 6 trading weeks. I think if you were to look that up, I don't have that exact number in front of me, but I think if you were to look it up, you would see that that's pretty close and pretty accurate in terms of how far the Dow Jones has gained. The NASDAQ, of course, is now firmly in positive territory on the year. The Dow probably still has... it's got to get back to 29,500 to be at an all-time high, back to an all-time high and where it was earlier this year. Yesterday, it finished about 27,500, down a few hundred points from that today, 27,272 at the close today. So still a couple thousand more points. And honestly, the Dow Jones has picked up. It's gone from 25,000. It finished above 25,000. Let me see. Bear with me, and I'll tell you the exact date that it did that. Dow finished above 25,000 for the first time since it slid. It finished above 25,000 back on May 27th. That was the first time it was above there since the big slide at the beginning of the pandemic, going back to it crossed below 25,000. It dipped below 25,000 on February 28th. It had not been up to 25,000 since March 10th. And then, of course, it just got back above it. It crept back above it for the first time on May 26th and then finished above it on May 27th. Okay, since going back above 25,000 points on May 27th, you had 2 days after that the Dow sold off a little bit, not a lot, but a little bit. So at the close on May 29th, the Dow was at 25,383. 1, 2, 3, 4, 5, 6 trading days later, the Dow closed at 27,572, about 2,200 points. So in 6 days, the Dow Jones traveled high enough or gained enough points that a repeat of that would actually take it back to all-time highs. So if you think that we couldn't get there, and I mentioned this in yesterday's podcast, if you think we couldn't get there before the month of June is over, think again. I'm not predicting that it will happen, because I'll be honest with you, even though today is just one day of downward movement, I'm always honest with you, but just because today, just one day of down movement does not create a trend, I do think we could pause a little bit around this 27,500 mark on the Dow, maybe a week, maybe two, where it's wobbly a little bit, maybe between 26,500 and 27,500. We could wobble in there for a little bit and then start making the push. We could maybe still get up to 29,500 by the end of June, but I'm going to predict it's in the first or second week of July. And as we hear the early reports on earnings that come in the first couple weeks of July, when the financial companies start reporting in the second week of July, companies like Goldman Sachs, J.P. Morgan, Wells Fargo, Bank of America, they usually have their report early in the month. And then usually by the middle of the month, you have a report from Netflix, and then you start getting into a whole bunch of tech companies. But as we start to get those early earnings reports, if we haven't already crossed over 29,500, that's when I think it's going to happen. So I think we're 5 or 6 weeks away. Yeah, maybe even 7 or 8 weeks away, more realistically. But I've been wrong before. We could have another surge like this past 6 days and see this thing fly up over 29,500. Meanwhile, the Nasdaq already, touching a brand new all-time high today. I mean, just absolutely incredible finishing today. I think I mentioned already 9953.75. The only one of the three major indexes finishing to the upside. And back in the month of February, prior to the pandemic sell-off, the Nasdaq hit a new all-time high on February 19th, when the highest point it got during the day was 9,838.37. So 98.38. We went back over 98.38 for the first time 2 days ago on the 5th. Or excuse me, I guess that would be several days ago. That was Friday the 5th. We went over there. Didn't finish above there, but went over there and only missed it by maybe 30 points or about 20 points shy. And then, of course, yesterday we finished above that at a new all-time high on the NASDAQ. So pretty incredible stuff going on in the midst of government shutdown and pandemic. I heard a news story just to give you an idea. Like I said, I'm not going to, the program is moving markets. I forgot to mention, by the way, at the beginning of the program, our sponsor once again today, Hurley Investments. Hurley Investments, if you ever need someone to trade your money, if you don't want to follow the investment strategies that we teach at Safe Option Strategies, Hurley Investment is a place to go. Check them out at hurleyinvestments.com. I'm not talking a lot about what's moving the markets today because honestly, I just think it's profit taking. I think that there's been such a surge, such a move up that people are going to pull profits off the table. That should be expected. And when there's profits being pulled from one area, usually that money is being put into the other area. A lot of people that trade and invest don't like to be in a lot of cash. When they pull money out of one thing, they like to put it in something else. I think that's what you saw happening, and I think that's why a couple of names like Apple, Amazon, Netflix, Facebook, the famous FANG stocks. We've been using that term for some time now. Even though the parent company is now called Alphabet, if you consider the company Google, which it is, Facebook, Apple, Amazon, Netflix, and Facebook, Apple, Amazon, Netflix, and Google make up the FANG stocks, and they were the winners today. People were going back to what worked for them for so long and worked so well through all of 2019 and even into the early part of 2020. They went back to those stocks, and it paid off for them. It paid off in a big way today, at least. Amazon closing at a new all-time high, getting a little bit higher during the trading day than where they closed. I think at the highest point today, Amazon got to as high as 26.26. They closed at 2,600 even, 2,600.86. I mean, absolutely phenomenal. I had a chance to get into Amazon when it was $50 a share, and I didn't get into Amazon because I was worried about Amazon not being able to turn a profit. I've stayed out of Tesla for the longest time as well. And I'm not bragging about either of those things. I'm saying shame on me. Let's see. See if we can get Tesla on here. All right. Tesla, finishing today at $940 a share. Got up as high as 954 at one time. Boy, do you remember the days? Um, and I said the same thing for a while, for several years. I said the same thing about Tesla that I'm saying about Amazon. Even when they were down at $175 a share, I thought Tesla was way overvalued. I thought Tesla was trading for way too high a price, considering that they had never made a profit. But Elon Musk, I never shorted the stock. I never went against Tesla, but I never wanted to buy Tesla shares. Elon, you have my apologies. I should have. I wish I would have seen your vision and understood better sooner what you had going on there. But all in all, not a big deal. Even though the Dow, the only disappointing thing for me today, watching the market, is how things sold off a little bit into the close. It wasn't too far, probably less than an hour to go in the trading session today. The Dow was only down about 160, 170 points. And then it had that accelerated sell off into the close. I'm not crazy about that, but the volume today, not crazy high volume. It wasn't something to get concerned about. In fact, the sell off volume today, I'm getting a chart in front of me that'll give me a better. Yeah, not as much, not even as high as the buy volume for the previous 2 days in terms of the one day. 381 million shares of the Dow Jones Industrial Index traded today. That's not a lot. That's a good solid number, but when the Dow is selling crazy high, it's up close to the 900 million or 1 billion share mark. And it wasn't even close to that today. So a moderate, solid day in terms of volume, but moderate in terms of not being really big or really crazy big volume. So nothing to get too alarmed about. I think over the next couple of days that Jerome Powell, I think maybe he heard my podcast yesterday, because he pretty much said today in some of his comments that the Fed is committed to doing whatever they have to do to keep the economy propped up. Uh, I think that's the smart move, and I hope when he takes questions tomorrow, that was some prepared statements. I hope when he takes questions tomorrow, that Chairman Powell will go to the cue card that I've prepared for him, and no matter what the question is that he asked, even if he's asked what he had for breakfast that morning, his answer to the question needs to be, the Federal Reserve is committed to doing everything within our power to continue to stimulate the economy and keep things moving in an upward direction. That's all he has to say. Anything more than that, he risks screwing things up, and you could have another sell-off day. I suppose there are some things he could say that would cause things to go up a little bit higher. I think people are going to want to hear the status quo as far as what they hear from the Fed tomorrow. I think the markets have a great chance after noon Eastern time, which is the time that he'll typically end his comments and start taking his Q&A. That's when they'll give the decision on rate increases, and the decision is going to be no decision. The decision is going to be, we're not going to raise them, we're not going to lower them, we're going to set here. And people are going to ask him about negative interest rates. People are going to ask Powell, or do you go negative on the interest rates? Even that's a question I think he shouldn't answer. I think he should smile at whoever asked the question and say, we are committed to doing everything in our power to keep stimulating the economy and to keep the markets and jobs stable. And that's all he has to say. I'm telling you, Mr. Powell, if you're listening to me, if anyone knows you and is listening to me and will share this with you, if that's your answer, you would get a good chuckle too. Think about it. You would get nothing but accolades if you said this, especially when it does not even address the question that you're asked. Let some moron reporter say, "What color are your socks today?" And did that have anything to do with the Fed's decision? Smile at them and say, "We're committed to doing everything in our power at the Federal Reserve to keep stimulating the economy and to keep things moving forward in a positive direction." And just repeat it over and over and over again. I want you to memorize that. And no matter what question you're asked in the future, that will be your answer. And you'll never have an impact on the markets one way or the other again. the markets will never be up. They'll never be down because of what the Fed says. Remember this again, Mr. Powell. With all due respect, we still all blame you for the horrible fourth quarter we had at the end of 2018. I know that's almost a year and a half away now. In fact, it is about a year and a half away, but it's still fresh on my mind. I still blame you for that. Your comments in that early October press conference that you did. Boy, I know you'd love to have a do-over. I think you're a smart guy, and I'm sure you'd love to have a do-over, but you don't get it. So anyway, there's a few other things going on, not necessarily things that are moving the market, but a few things of interest. I saw an article, and I can't even find it now. It was a headline article about a half an hour before the markets closed, and now I can't even find it in the trending headlines on MSNBC, or excuse me, CNBC or Fox Business News. I don't find it on either one, but a couple of economists, and I wish I could remember their names, were trying to make the case in a report they published that if we had negative interest rates, we would be able to have a V-shaped recovery. Now, maybe it's good that I can't find the article now, because my temptation would be to really go after and rip on these people that published this report. And the reason being that it's an absolute ridiculous report put in the context of the fact that we've already had a V-shaped recovery. We're already in a V-shaped recovery. Now here, I'm going to give the writers, if you know who wrote the report, I'm going to give them some credit. I'm going to back off a little bit. They were probably beginning this report a month ago, maybe a month and a half ago, when we'd had a little bit of an uptick in the three major indexes from hitting the bottom that we hit in that early week in March, week and a half into March. We had like a little mini V-shaped recovery. Then things flattened a little bit, and it looked for a little while like maybe we were going to have one more pullback, maybe a test of the lows that we hit a couple weeks before. That's probably around the time that they were writing this and doing some research and putting this together and trying to, wow us with their brilliance that if the Fed would go to negative interest rates, we could have a V-shaped recovery. It probably took a while to get the report finalized and published and had some peer review and stuff like that, because the timing of the report, why it would get mentioned today, speaks to the low standard of editors, the people that make the decision on what gets printed in the news and what doesn't, what goes out on the internet and what doesn't. It's a low bar. I mean, I don't know what a person has to do to qualify for that job. But making smart, logical decisions is not a requirement, because putting that out today just doesn't make any sense. We're 90% of the way to a 100% V-shaped recovery. And whether we're all the way back to a full recovery, we are in the NASDAQ, we're getting close on the Dow, we're getting close on the S&P, whether we're there or not, it's been a V-shape. So it's kind of silly to print an article like that. And I'm kind of glad that, an hour ago when I was looking at it to now, it's not trending anymore as one of the main headlines. I don't know if that's because no one was reading it, or if it's because someone said, maybe someone said, hey, that's a dumb article to have on there, and we should pull it off. There's other economists. There's Moody's chief economist Mark Zandi said the U.S. could slide into a second coronavirus-induced recession if the federal government does not pass additional economic relief measures. That is such a fallacy, and that is such a wrong way to look at it. In fact, I would tell you exactly the opposite. If Congress passes another round of what most people consider free money, If they throw more money at the problem, it is going to have exactly the opposite effect. Fewer people are going to go back to work. The deficit, the debt are going to go up even higher than they already are. They're already ridiculous. We're going to have to pay the piper one day, and it's not going to be pretty. But you cannot continue to give people incentive to stay at home. The incentive has to be to get back to work. Now, I mentioned this in yesterday's podcast. Not every job that was lost is going to be regained in the same job. Not every company that laid people off is going to be able to hire back everyone that they laid off. A lot of people are going back to work, and a lot of people are going back to work in the same jobs that they had. Other people are going to have to go back to work in other jobs. Keep in mind, before this pandemic, before the government forced us into a recession, and I'm not saying that in a complaining way. Let's just make sure we call it what it is. This was a lockdown induced recession. We were told to stay home. Businesses were forced to shut down. They were instructed by their local governments to shut down. That's what put us into this little recession. And I say little recession not because of the depth of recession, but because it's going to be very short lived. But you send all these people home, and then you give them a lot of money to stay home. That's the worst thing in the world you can do. Look, I have an issue with the fact that there are people making more money already to stay home than to be at work. But I understand the need for it to be done. I'm not against the fact that we did it. I wish some more checks and balances would have been put in place. But I understand the need to do it, and I'm grateful that it's going to have a deadline. Remember, back before this government imposed recession, there were more jobs than we could fill. There were a greater need for workers in different areas than what we had people willing to take the job. So guess what? A lot of those people that aren't going to be able to go back to work specifically in their industry or back to their same company or same job, they might need a little bit of training. They might, whether it's some on the job training, whether it's a few months in a vocational school, they might need to go pick up a skill that they didn't previously have. But there are jobs there. That there is a chance that before the end of this year, not only could we have everyone who lost a job as a result of the pandemic back at work, but we could have more people working than that. We could have an even bigger percentage of people working. And that's a tall order. That may or may not happen. I don't know if we'll get there before the end of the year. I will tell you, if we put Joe Biden in the White House in November, I will tell you that jobs will drop off in November and December. We will go into at least a year-long recession, and the stock market will have a repeat of 2008, and we will be down over 50%. I will tell you that that's going to happen because if Biden gets into office, he's not going to do anything at all. He's going to lie in bed or sit in his room in the White House with a blanket over his lap and nursing a cup of coffee and having people change his diaper while the other people he puts into place in his administration are running things. And it's going to be all the people that worked in the Obama administration are going to be back in the White House and back in the administration in some form or another. And I'll tell you, it's going to tank this economy. It is absolutely going to tank this economy. So, but if we don't have that happen, and hopefully we won't, you're going to see this market, if it doesn't, and not just the market, the stock market's going to recover to where it was at within the next 6 to 8 weeks, if it even takes that long. The rest of the economy, meaning the unemployment rate, the construction work, housing, all these other economic indicators, the manufacturing data, the Chicago PMI, all these different things, they're going to be back to where they were and better, if not by the end of this year, very early into next year. One other story that I wanted to make mention, there was a story that came out. I think we talked about it in our live class with our Safe Option Strategy students. We talked about it a little bit this morning. Some economist um, said that we officially entered a recession in February. That's flat out wrong. That's flat out wrong. We may have obviously we hit the peak of the economic recovery and the bull market that started back in 2009. When the market began to recover in mid-March of 2009, it was around June of 2009 that we had moved up 20% off the most recent lows, and we're back into a bullish market. If you take us right up to February of this year, you're talking 11 and a half years plus of a bull market that we have been in. And February may have been the peak, but we did not enter a recession. We started to see some contraction, and it was exacerbated through the end of February and the early part of March, but we did not enter a recession in March. By definition, a recession is 2 consecutive quarters of economic contraction in the GDP. So I would ask you a question. With the GDP growing in the fourth quarter of last year, and by the end of the first quarter of this year, it had contracted, and we don't have the quarterly numbers yet for the second quarter. We are technically now, everyone knows that second quarter is going to be another contraction. We're not expecting something different than that. But technically, by definition, we are not in a recession until we get to the end of the second quarter in a row, and we have the economy contracting 2 quarters in a row. Based on the jobs numbers that came out at the end of May, I'm telling you right now, don't be shocked if GDP was only down a little bit in the second quarter and goes up in third quarter, and it's going to be barely a recession prior to going back into economic expansion. So, the National Bureau of Economic Research are the ones that said that the U.S. entered a recession in February, officially bringing to end a record-long expansion. I suppose you'll be able to look back and say, we begin contracting in the month of February, and I guess that's accurate. The way it's presented is what I think is spin. And they're even saying it'll be a 3-month recession, the shortest recession in history, but also the most severe. Some of the things these people say just make you scratch your head and wonder where their brain is at. I don't know. It's not going to be, if it's a 3-month recession, let me ask you this. Because of what the definition of a recession is, how do you have a 3-month recession? By definition, you got to have 2 quarters in a row of economic contraction to be in a recession. So you ask the question, you answer this question for me. How do you have a 3-month recession? I don't think it's possible. I don't think you can have a 3-month recession. If I'm wrong, I'm wrong, but it makes no sense to me. All right. Not a lot else to talk about. I'm going to wrap it up right there. Not a great day on the market unless you're completely in the NASDAQ and heavily invested in Amazon, Apple, Facebook, Netflix. If that's where your money is, you're loving today. If not, a little bit of a down day, about 1% on the Dow, about 0.75% on the S&P. And it could carry over and bleed over a little bit into tomorrow. But if Jerome Powell will take my advice and do what I tell him to do, I'll give it to you one more time, Mr. Powell, Chairman Powell. The Fed is committed to doing everything in its power to continue stimulating this economy and keep things on a forward-moving path for economic recovery. Memorize that, Jerome, and repeat that no matter what the question is that you're asked. That should be the only comment you make throughout your entire press conference tomorrow. And I will promise you this, if that is the only comment you make throughout your entire press conference tomorrow, the Dow Jones Industrial Average will be up 350 or 400 points before the end of the day, having got back everything it gave up today. Folks, that's it for moving markets. To learn more about what we do at Safe Option Strategies, you can go to safeoptionstrategies.com, or a slightly easier to remember URL is sostrades.com. Check out our podcast on sostrades.com. Subscribe to it. Tell all your friends about it, and join us here most days. I'm going to be taking some vacation next week, so there's probably only going to be a couple new episodes next week, and no episode this Friday because I'll be driving out to California on Friday with my family. But most days right at the close of the market, we're here live on YouTube Live. Join us if you can, and good luck on all your trades. Hope they're all profitable for you. Thanks.